So I'd like to first of all acknowledge that I'm coming to you here from the Lekwungen speaking territory, which is the Songhees and Esquimalt Nation, where I am lucky to get to live, work, and play. And fortunately today it's a little bit chilly, so I'm not sure what happened here on the West Coast, but we're in the minus 2-degree situation, so crisis. Anyways, if everyone can mute, please, that would be fantastic. And then we don't get any background noise. And for anyone who is wondering, we will be recording the session. We have recorded it and we will send it out afterwards. And you can feel free to share it out. So I'm Christy Fairholm-Mader. I'm the Managing Director of the Thrive Impact Fund, and I'll talk about that shortly. And this is Emmeline Le Guen, who's our Impact Investment Manager, and she will introduce herself a little bit further down the road. Next slide, please. So the Thrive Impact Fund is launched in September, and we're focused on investing in BC. And we're really looking at investing in what we call high impact organizations and social enterprises. So that's nonprofits, charities, co-ops, and for-profit social enterprises that have a specific purpose of trying to achieve a environmental, social, or cultural outcome. So we're looking at those where the impact is in the DNA of the business or the enterprise or the work that they're trying to do. Advance, please. So as I mentioned, it's a place-based fund specific for BC, and we're investing a lot focused in smaller communities. So we're looking at Island, the Okanagan, interior BC, the coast, and looking at trying to flow capital to places where capital doesn't necessarily flow, and to organizations where capital has not necessarily flowed easily as well. So that's the focus on being able to create products and create financial investments that focus to where we have not seen that kind of financing be able to flow traditionally. So we're really looking for those financial and impact returns and investments. We've created flexible and patient debt finance, and one of the barriers that we remove is the need for collateral, which we know is a huge barrier for many nonprofits, charities, for co-ops, as well as for entrepreneurs that may face some systems bias or don't have wealth behind them in order to provide collateral. So we're really looking at financing those entrepreneurs and social enterprises. We wrap around community and supports around our investees to help them succeed, knowing that none of us do it alone. And so we build that connection not only to the expertise that Scale brings, who has launched and founded the fund, to Purple, who's our co-partner in the fund, and we work significantly with nonprofits, charities, social enterprises around their capacity building, but we also really work to develop relationships amongst the peers of investing. So we're really saying, we know that so many people bring really significant expertise, and so to provide connection and space between these organizations is key. And our goal is to help provide gaps, to fill gaps in the system, and to ladder organizations towards more traditional types of financing, and to look for co-investment opportunities. Next slide, please. This is another way to look at it. It's really focusing on that right capital at the right time, focusing and looking at early revenue, early capitalization, growth and acquisition. So that's where we're looking for enterprises, the type of enterprises that will finance in terms of the stage that we're at. So we're not at startup, but we're around when revenue has been proven. It might be very early revenue, but that we pick up and help to grow. And the type of debt that we provide is patient flexible loans, and we're going to talk a little bit about that, and revenue-based financing, which we spoke about in our last social finance chats. And then the capacity building, as I mentioned, the mentorship, the peer learning, and the ongoing support that we provide. Next slide, please. And so one of the things that we really found when we were working so much with the types of social enterprises that we did is that equity provides a real value, right? Equity comes in and provides patient, long-term, ability for this kind of capital that allows businesses and allows enterprises to get their feet underneath them, to gain access to skills and networks of support and be able to grow. And then we began to really notice that for many of the organizations and social entrepreneurs that we were working with, is they weren't able to access this type of capital. And so then they end up in traditional debt, and traditional debt is not patient or flexible, but is very much like a metronome, right? And so we, just to remind everyone to please mute yourself if possible. Thank you. So we don't get any background noise. And so we saw that there was, with equity, that you have an investor as an active shareholder. They share the risk, they step into it with social entrepreneurs, and it also provides, that equity on the balance sheet, it shows as an asset. And so that's all things that equity really brings. But the challenges are for organizations that do not have this kind of share structure, they just can't access it at all. And that for-profit social entrepreneurs, we saw that there was this kind of not so sure that they like the loss of their ownership. So giving up shares in exchange for this type of capital. And so we can see that there's some challenges with equity. And that also equity and venture capital tends to require very high growth and exit planning, and can be quite complicated, and valuation of businesses and all this kind of stuff that makes equity investments a bit more complicated. And so we began to really think about, like, how do we make debt act like equity? So knowing that some of the structures, debt and equity are different, but if we could create debt that act and provide some of the benefits that equity brings, that's where we want to look at how Thrive Impact Fund can fill that need. So with that, we created 3 different tools. We have an early revenue tool. You can advance, Emmeline, to the next slide. Which we've allowed our financing. Remember, we said the right capital, right time, allowed our financing to be very flexible and to bring in sort of the long time frames to be able to structure the terms so that we're providing that kind of benefit that equity can provide, and look at things like revenue-based financing, which collateralizes the revenue, not external, not other sort of assets collateralization, and to use these tools to bring the spirit of equity forward into a debt product. So now I'm going to pass over to Emmeline, and she will talk about some of our thinking behind it and what we look at in terms of creating equity-like debt, as well as just that concept of equity-like debt in general.
Thank you, Christine. So hello, everyone. I am Emmeline Nguyen, and I'm the Impact Investment Manager for Thrive Impact Fund. I have a background in community economic development and impact investment in France and in Canada. And I'm really glad to have you here today to talk about equity-like debt. So what we mean by equity-like debt, as the name says it, it's a debt product by nature, but that behaves like equity. It means that it's future focused. It looks at future growth perspectives and cash flow rather than past performances. And the investor is able to share the risk with investees and be closely associated to the success of the project as an equity investor would be. This comes with active support from the investor that behaves like a committed partner without having to take ownership on the company, since there is no share purchase involved. And it fills a gap for nonprofits and charity who cannot access equity financing since they have no share structure. So if you look at the balance sheet, when you talk about equity-like debt, it sits between the equity compartment and the traditional debt, and it can take different forms of financial product. It's also called quasi-equity sometimes. The most common form is subordinated debt. It's a debt line that is subordinated to the traditional debt that you would get from a bank or a credit union, for example. It involves that the traditional debt will be repaid first in the event of default, then will be the subordinated debt compartment, and then equity to shareholders. What that generates is that it reflects the level of risk that is taken by each financial stakeholders in the company and provides more long-term liabilities to the organization. The return that is expected is also aligned with this level of risk. Quasi-equity product can also be convertible notes, which are bonds that can be turned into equity if the financial situation requires it. If, for example, the cash flows are not sufficient enough to pay a fixed debt payment, then the bonds will be converted into equity, meaning, again, that the lender becomes a shareholder and takes more risk in the company. And revenue-based financing, which is one of Thrive Impact Fund product that Chrissy mentioned, is also an equity-like that product, being unsecured and flexible in payments, linked to the growth of sales with a repayment by a percentage of revenue, And as we said, we have had our first social finance chat about this topic, and you can rewatch that on Scale's website. On an accounting basis, the advantages of equity-like debt are the following. It is categorized as equity in the balance sheet and provides long-term liabilities, meaning it also helps leverage other type of financing, and especially traditional debt. It will be repaid after traditional debt and before equity. The repayment profile is flexible like equity, but predictable like debt, which gives an easier capacity for the organization to monitor payments and is more gentle on cash flow. And it involves building revenue projection and a close follow-up on them, which generates generally a stronger financial knowledge and financial modeling capacity in the organization. We are now going to look at each type of financing with very simple examples, just to explain how the products are built. So if we start with equity, in an equity deal, the repayment capacity is based on the pro forma of future revenue and cash flow. It's a bet on the future, hence the risk is higher and the return expectations as well. For equity investors, there are chances that one deal over 10 turns into a high profit enterprise when 9 will fail, meaning they will have to plan the exit, and when they bring cash by purchasing shares, it also makes them a shareholder of the company with or without voting rights, and they are generally closely associated to governance and strategic planning. An ideal fit is what is called in the venture world a unicorn. Very high growth potential, double, triple digit figures, generally a startup project coming from a highly innovative idea of an entrepreneur that will address large and growing markets. In this case, we took the example of a clean tech startup with larger upfront cost, developing a product ready to go to market, needing funding for R&D. They won't be able to repay fixed amount in the first years, but they have a very big potential to grow and create value. The company, in that case, can also be very interested in having support from an expert investor in the field. And the exit, again, has to be planned. Generally, it involves selling or entering stock markets. The repayment profile of an equity deal, traditionally, dividends are paid throughout the life of the investment if the cash is available. In that example, we took an assumption of 15% dividends. And they can also be cumulative if the revenue generated doesn't provide enough capacity, meaning investors take also the risk of not being paid $1 in the first years. And the exit of the investment comes with a balloon payment, where shares are repurchased. So you can see here that definitely everything happens at the end of the deal. For traditional debt, here we sit in the opposite realm of financing, where traditional debt is based on the capacity to repay on past performances. Payments are fixed throughout the life of the investment. They don't really move, and generally collateral is required under the form of assets. It's a low risk, low return deal. Lenders are usually passive investors. They follow up on payment, but are not involved in the strategy of the company. The ideal fit for a traditional lender is a steady performer, since it's based on past performances, meaning you need to provide good track record, a comfortable line of income and cash flow with an existing capacity to repay. And generally, on top of that, ensure that you can offer some piece of collateral. So again, any type of asset, being real estate or machinery or inventory, can be a good fit for traditional debt. Repayment profile, generally fixed payments of principal and interest. And since the principal is repaid progressively, the interest part decreases in time. So now we come to equity like that. And it definitely sits in the middle of these two approaches in the way that it looks at both past and future performances to assess existing margin for repayment, but also takes into account future performances. It can be less strict on securities can take second or third rank on an asset or cash, and even going unsecured as an equity investor does. In that sense, it is definitely an equity mindset linked to a debt product with a higher tolerance for risk and is more closely associated to the success of the project. Being a debt product, there is no share purchase. The investor is not officially involved in decision-making, but can take an active role in supporting the entrepreneur towards success. The ideal fit is a proven organization with some track record, but still some elements of risk, sitting in that state of early growth and looking for financing to expand, while still needed some flexibility and runway in payments, and maybe unable to provide collateral and to take equity. We can take the case here of a nonprofit, expanding a social enterprise like a thrift shop, where margins are high, there is potential to grow, but it's still a bet on the future, and they will struggle finding the proper financing with traditional lender, maybe, especially when no collateral is available. Here's a representation of the repayment profile of such a flexible product. We took the case of revenue-based financing here. 5% of the monthly revenue goes towards loan repayment. It's a pay-as-you-grow model that we describe more in details during our latest chat, as I mentioned earlier. As a summary here, you can see how equity-like debt definitely sits halfway between equity and debt, sharing some features with both. It provides the flexibility of equity without the loss of ownership and a lower pricing, while being a way more active investor than lenders, able to take more risk and provide strong support. To come back to Thrive Impact Fund financing offer, you can see here the three types of equity-like debt product that we provide and Christy presented: patient and flexible loan and revenue-based financing. We can have terms up to 7 years. We're flexible in collateral requirements, and our pricing is risk adjusted. What makes TIFF an equity-like debt investor is that debt products are tailored to your revenue trajectory, and we're risk tolerant in an equity mindset. We customize the right tool adapted to your organization's financial projections. Would it be about duration, grace period needed, or collateral? We adjust our pricing with risk, but also with impact, meaning we assess risk with regards to revenue projections and adjust the price range, but we're also able to align our pricing for demonstrating high impact and make sure that the tool can match the goals of the organization. And as an active investor, we offer capacity building to the investee to guide them towards success through coaching, peer learning, and making sure we keep their mission and impact at the core of the support TIFF offers. I hope you enjoyed this presentation. We're going to move to a Q&A now, but just as an information purpose, our next event is the Thrive Impact Fund information session that is happening on March 8th. We can maybe put the link in the chat after that. And as for the next social finance chat, the upcoming one will be on March 29th, and we will talk about developing your financial mix. Here's my contact information. If you ever want to reach out to learn about TIFF or products, the application process, I'd love to chat, and I'm always happy to walk you through the different components and learn about your project. And now we're gonna have time for questions, so feel free to turn on your mic and your camera. We are still in a small number today.
I see that Tanya had a question in the chat, Emily.
Right.
Hi, thank you for this fantastic presentation. I'm really, really inspired by your approach. My question would be specifically about the company having their kind of share structure, being able to take in something like this. Do they need to have a new share class created? Or maybe you can talk a little bit about that, whether how easy it is to kind of integrate into what you were talking about, like, I think, and I might have missed this little piece, was with nonprofits and charities, they don't have this kind of share structure. How do you implement it, and is it different for enterprises that do have a common stock share structure?
So it is not, and this is the beauty, one of the beauty of equity like that, it can really address the whole array of impact organization, meaning it's definitely debt, and it will come even for a for-profit social enterprise, it will come into the long-term debt liability part of the balance sheet. So it won't tackle the share structure, it won't come as any type of equity to shareholder, but it's really classified as long-term debt, and very much in the top line of it, because again, it will be repaid in the last position.
So
But
it
it
still
doesn't
shows
require,
up. Okay.
sorry.
So it still shows up as debt. However,
It does.
everybody reading through the documentation see where the risk is in terms of it, and more
Absolutely.
sitting like a note than any less that way.
But it is generally perceived as quasi equity, especially by traditional lenders. Let's say you want to leverage some debt for a project. Your bank will look at this loan being unsecured, being flexible,
Right.
being lasting payment priorities. They will look at it as some kind of security in your balance sheet.
Awesome. Thank you.
You're welcome.
Emmeline, Gordon Holly has a question more sort of going a little bit deeper into that, which is how does equity like debt turn up in the equity section, and can, like, in terms of the balance sheet, and do accounting regulations allow for this? And I'm just noting we have 3 minutes left.
Mm-hmm. So same answer. It really comes into the long-term liability and long-term debt side of the balance sheet. It will just, again, show up as a different way than traditional debt, being in a more risky position, and so providing more stability to the organization, more as an equity investor would be. And so accounting regulation don't really intervene here, and in the way that it is still debt. So it's definitely covered by any type of regulation around that.
Great. Does anybody have any other questions? If you do, you see that Emmeline has put her email down below, and feel free to reach out anytime. We do have upcoming information session, as mentioned, on Thrive Impact Fund if you're interested. And we tend to have both investors and investees turn up to those sessions and have a conversation about Thrive Impact Fund and what it's trying to achieve and what the offer is. So feel free to join us for that. And then our next session will be creating a financial mix. We'll talk about capital stacking and how to create and look at what kind of financing is required and how to bring in different types of financing in order to achieve the goal of projects. So thank you so much. It's great to have everybody here. And if you have additional questions, we'll stay on the call for a little bit longer as needed. But yeah, enjoy the rest of your day and your lunch for people who are calling in from the East Coast or from the middle of the country.
And I will send over the slides and the recording later in the day or tomorrow with the links to register for our upcoming sessions.
Thank you so much.
Thanks, everyone.